Thank you for tuning in and welcome back, team. In today's episode of Real Estate Advice, you'll learn about buying a house with bad credit. Let's separate the myth versus fact and get you the right information to help you move forward. My name is Andrew Finney, your real estate geek. If you need help finding a top agent where you live, or if you simply want to drop me a line to say hello, my contact info is below. If you haven't already done so, please go ahead and subscribe to this channel now and like this video. Thank you. Okay, team, so let's talk about this. The reason that I'm making this video today is because I care about you, and I know that we may never ever meet in person, but by virtue of this video, we can connect, and I care about you and don't want you to get hurt. So I'm going to make a video. Today's video is about bad credit and buying a house with bad credit and separating the myth from the fact so that you know what's real and what's not real whenever people approach you or when you hear different marketing slogans out there, okay? So there's going to be three main points throughout this video. I'll go over them real briefly and then we'll dig into them. The first one is actually assessing your credit, assessing your ability to repay the loan, and then third is what if deciding to put homeownership on hold is the right decision for you and how to tell. Okay, so let's go back to assessing your credit. When we're assessing your credit, there's a host of tools out there. Obviously, you know, there's Credit Karma, there's all kinds of other credit servicing companies out there that will provide you with your credit score in real time. I personally use Credit Karma, but it's important to note that Credit Karma is not accurate. It's a lot like a Zillow Zestimate on a property's value. What happens is they're giving you kind of a benchmark range. If let's say that they say your credit score is like a 620. Well, your credit score in reality may be a 660 or it could be a 580 whenever you actually get your credit pulled. There's different types of credit. There's more than just the three bureaus that are assessing your credit. There's things called Vantage scores, and there's actually credit scores just for buying a home, different credit scores for buying a car. There's so much stuff that goes into the lending world, it's easy to get it confused. And that's why we're going to cut to the chase and start making it very simple to understand very quickly for you so that you know what's right and what's wrong, and you can easily identify it whenever you're looking at it. So in the first situation with assessing your credit, when you hear of like no money down loans, they're generally talking about a down payment assistance loan or a home as possible. When you hear of bad credit loans, whenever you hear bad credit loans, there's a couple of different things going on there. Generally, it depends on what one terms bad credit. It's a nice little sexy slogan to say, oh, you can buy a house with a bad credit. But what is bad credit? We need to quantify that number and what that actually looks like to know what bad credit means to them. Bad credit, what it means to us, may be something completely different, right? So we need to know what that number looks like. So going back to loan types that actually have technically no minimum credit score requirement, those are your VA and USDA loans. A VA loan is only open to those that are currently serving on active duty or have been honorably discharged from the military and are now military veterans of the United States. The second one, being a USDA loan, is actually a loan through the Department of Agriculture for rural areas only, right? So rural areas. So in other words, if you go out and there's not a whole bunch of houses around you and there's like farmland and stuff, consider that like a rural area. That's where, and about 95% of the United States is rural, so this loan type would be available to 95% of the country. But here's the kicker. Whenever I talk to the two loan officers that I work with here in Las Vegas, Bill Marin and Josh Coomer, about how this actually works in practice. They say, yes, Andrew, it's true that VA and USDA don't have any minimum credit score requirement. But here's the deal. A lot of brokerages, a lot of lending institutions do have minimum requirements, and they generally won't touch those with a credit score under 580. So when we start talking about bad credit, if your credit score is below 580, then we need to do some work, perhaps getting you in touch with a trusted real estate advisor to introduce you to a top local loan officer so that you can begin doing what's called a rapid rescore and see if that's an option for you, or perhaps putting you in touch with a credit service company that's going to assist you in boosting your credit. It's really important to note that you're going to start getting better deals and better rates when you start reaching a credit score of 620 and above. At 640 and above, it gets better, but to qualify for a couple of those programs, whenever you hear no money down, as I was saying earlier, that 640 to 660 is a minimum FICO score to qualify for those no money down loans right now. So it's important to know that whenever you're assessing the credit and assessing your options, that if you have a 580 or above, yeah, okay, you might be able to get approved. And that's the key word in that sentence, might be able to get approved. It's going to depend on your overall situation with what's called debt to income ratios. I'm going to put out a video this week about how to use a mortgage calculator so that you know how to use it. So go back to that video about how to use a mortgage calculator and watch it. And that way you know what debt to income ratios are and how they play into getting a home loan. Keep in mind that if you're looking for the down payment assistance and home as possible loans, you're going to need to have a higher credit score, generally over 640 on the low side, okay? So then let's talk about the ability to repay. That's a very significant thing to the loan officers, right? Obviously, if they're going to issue you a loan, they're determining your credit worthiness and your financial ability to repay. Now, what happens is when you submit a loan application, if your credit score is too low, it's going to kick back what's called like a red flag through the underwriting process. And if you have too many red flags, even with just one red flag, then it turns around and has to be assessed, and they're going to start asking you for more documentation. Now, let's say that you have large amounts of debt and you have small amounts of cash. Your options are going to be very, very limited as far as what loan programs you might be able to qualify, if at all. So you've got what's commonly referred to as like a capacity issue, if you will, a capacity of cash in relation to your debt. So in other words, your debts exceed your income, and your ability to repay said debts puts you over a debt to income ratio limit. So when I've mentioned now debt to income ratios quite a bit. If you want to play it safe, as a safe rule of thumb, you can call it a 40% front end ratio to a 50% back end ratio. I know that may not make any sense to you right now. You may want to watch the video that I made about debt to income ratios in specific that dig into that, if that's something that you would like to do to better understand that. So capacity is kind of a lending term that defines how much you can afford to borrow. So in other words, do you have the ability to earn the right amount of income to easily make the required monthly payments? And sometimes this is where people get tripped out whenever they're renting and they're like, hey, Andrew, I'm paying $1,800 a month in rent and I can't get a home loan because the mortgage officer said that my debt to income ratio is too high, but I can afford it because I'm doing it now. It's a very logical concern, and I'm right there with you, completely understanding your situation. I've been there before once, whenever I was renting too. I know how frustrating it can be when you get a loan pre-approval less than what you were hoping for, but you're paying out more than the mortgage is going to be. Those debt to income ratios are set by Fannie Mae and Freddie Mac, so those are actually lending guidelines that cannot exceed. I want you to consider something that those mortgage officers out there are actually doing you a favor, and so is Fannie Mae and Freddie Mac by not giving you a loan, even though you might be able to pay it in a rent, because when you tie it to purchasing a property, the reason they'd be doing you a favor is you would be house broke. If you've ever heard that comment, house broke, it's awful. We don't want you to be house broke. We don't want you to be in a position that is one of the reasons that people led up into the 2007 collapse, 2008 collapse of the financial markets and the real estate market overall, was because people were taking out too much. They were house broke. They were getting themselves hurt because they were buying more home than they could realistically repay. So having the ability to repay your loan easily and keeping your numbers in line are going to be highly, highly beneficial to you. So even if somebody gives you a great song and dance, and even if you're really, really tempted to bite the bullet on that, you probably shouldn't if it doesn't feel right. If it doesn't feel right, listen to your stomach, listen to your mind, and listen to your heart, right? If it doesn't feel right, it's not right, and it's not going to get any better. And at the same time, if it does feel right, maybe you do got that 620, that 640, or that 660 and above credit score, right? Then move forward if it feels right, because it generally is. But if it doesn't feel right, it's not going to get any better. That's just honest with you. I just don't want to see you get hurt. There's too much at stake when you buy a home to get anything wrong. It'd be far better going into our third point, which is deciding to put home ownership on hold right for you or not? It's important to really think about it, because should you even be home shopping if your credit or other underwriting metrics aren't up to snuff, like your debt to income ratios? Because the burden of a huge loan with a higher interest rate, because that's what's going to happen, the lower the credit score, the higher that interest rate is going to be, then you got to really start thinking between your debts, your car note, your credit cards, your utilities, your living expenses and such, do you really want to add other things into the mix? Because if you foreclose on a home or you short sell that home, that can damage you for many, many years to come and put a bad taste in your mouth. The idea here is to assist you in learning how best to purchase a property, work on your credit, and get it right, so when the time comes, you're happy and you'll never be feeling house broke, and you'll never have what's called buyer's remorse. We don't want to see you get hurt, because if that dream house that you're seeing today that's caught your eye and it makes you feel warm and fuzzy on the inside, if that dream home is there now and you lose it, or in your mind you lose it because you weren't able to qualify for a loan, remember something. Don't worry about it. Don't worry about it. Here's why. There will be plenty more homes on the market when you are ready and the time is right for you. So tell me what you're thinking about this video in the comment section below. It's a really quick video today about buying a house with bad credit, myth versus fact. There's been a lot of meat in this video today. You may want to watch some of the other videos I've made about this topic with debt to income ratios, ways to boost credit scores. Check them out in the home buying tips video playlist. Anyways, tell me what you're thinking about this video, what you took away, what was most impactful to you. Was it number one, actually assessing your credit and working on getting a better credit score? Or was it the second point, why lenders look at credit score and how they determine whether you're able to pay? Or perhaps the third point, is buying a home or putting home ownership on hold right for you? Tell me in the comment section below. Now I'm going to go ahead and pop up my contact information. If you have any questions for me, if you want to drop me a line just to say hello, let me know. I'd love to hear from you. If you haven't already done so, I'm going to ask you to do three things. Number one, please subscribe to this channel. Number two, please like this video. And number three, please share this video around with someone you know is going to be able to help. Thank you so much for watching today, team. In between now and next time, I'm wishing you and yours a lifetime full of love, wealth, abundance, and happiness. Enjoy an amazing day.